This is Dentist Money. Now, here's your host, Reese Harper.
Welcome to the Dentist Money Show, where we help dentists make smart financial decisions. I'm your host, Reese Harper, here with my trusty old co-host, Sir Ryan Isaac.
Hello. Welcome.
Thank you for welcoming me to the show
No
again.
one welcomes you.
I appreciate it. Now I do feel welcome.
You always welcome me. So welcome to you.
It's been another week
Yep.
of bumps and bruises.
Mm-hmm.
You wrecked on your bike once.
No.
Oh, you didn't?
I go really slow, though, so I make sure that doesn't happen.
You rode up a hill valiantly to the top with never stopping.
Yes, I did do that.
And sped there, which I think also Q, you made that happen?
I was there. Yeah, I didn't fall, which is always a good accomplishment.
Q didn't fall this week.
Have you seen you take a spill or two, Q, over the years?
It's because he goes fast, though. I mean, that's the secret.
For
if you want to fall,
listeners who may be interested, I did see Q go over his handlebars, feet in the air, into a small pile of rocks and brush.
There was a lot of rocks on the trail.
And I lived to tell about it.
You did.
The next day he woke up and played golf. And ran a little bit.
Ran a marathon.
Ate some hearty breakfast and just got back on that horse.
Well, we're talking about risk today. This is perfect.
Yeah. I thought that would make for a nice segue.
Yes.
Right into our podcast episode today about risk.
Mm-hmm.
We almost lost Q on the hill.
Yeah. How's your disability coverage, by the way?
I'll have to check on that.
Yeah, we'll go over it later.
This risk podcast I'm excited about because you and me have spent a lot of time trying to figure out how to, in financial planning, there's a topic called risk management where it mostly gets associated with insurance. Yeah. And people use the word risk management instead of using the word insurance because it sounds more sophisticated and it makes it easier to sell.
Yeah, we're going to talk about risk management.
The first thing that we want to talk about is when you and me I remember this 10 years ago, I was walking around the office and you threw a bunch of papers on my desk about a client that you had met with. And we were going through it, and it was just a big pile of mess.
Of papers. Yeah.
And if any of you have ever listening to the podcast today, if any of you ever engaged a service provider and you felt like you didn't really know what was going on, but you did hire them, but it's kind of like you're not really sure what they're doing. They just kind of live in this world of they're supposed to help you get something done. We'll call it in marketing, it happens. In consulting, it happens. In financial planning, it happens. In legal, it happens. In tax, it happens. Where you hire someone and you're kind of like lost around what did I pay them to do and what are they doing?
What's the process I'm going through?
What is the process I'm going through? I think risk management or insurance, risk gets lumped into insurance a lot. Mm-hmm. But risk management is a topic that's bigger to me than just insurance.
Right.
And we needed a way to figure out not only how do you measure where people's income is going and whether they're putting it in the right places.
How their net worth is growing.
But we wanted to figure out if people are taking too much or too little risk. Mm-hmm. And then what categories in their life
does that
really make up the risk bucket, right?
Yep. Yeah.
So the first element of risk, I'd like to let you introduce.
Yeah.
What is the first kind of main element of risk that we look at?
Well, I was going to ask, too, if this is anywhere maybe in the show notes or somewhere we could point to on the website. If you look at the block of elements, the 12 elements, this is the whole top row. There's 3 of them.
Underneath the services tab, if you go to our website at dentistadvisors.com, you'll see plenty of articles and content around the elements.
Yeah.
But we're going to have a whole section kind of walking you through the logic behind it. And what Ryan's referring to is in this periodic table, it answers some kind of big questions that we have as financial advisors. One is, when is someone going to be able to stop working? When is work optional for someone? Another one's, what's the right mix of assets that someone should have? And what is your mix of assets? How is your real estate and practice equity and retirement kind of distributed? The third question is, where's your income going? Are you spending it? You paying taxes? You paying debt with it? Are you saving it? And the last question that answers is, are you taking the right amount of risk? And we kind of break that into 3 categories. It's the top row in our periodic table. And the first element of the 3 on the top is?
Yeah, it's risks in your investments. So I was just having 2 conversations today, actually.
We call it your equity rate.
Equity rate.
It's a measure of how much risk you take compared to other people in your situation. And that's what we use to kind of look at someone and say, is this person taking on too much risk with their investment accounts or not? So
Yeah, having conversations today, 2 situations that describe the importance of why you'd want to track this. One would be talking to a young doc with $500,000 sitting in cash in a practice that has been early in his career, young, has a lot of time ahead of him, not taking enough risk, not taking advantage of the returns that can be associated with risk early in his career. On the other hand, I was talking with another dentist today who was he was discussing this practice buy-in that he had recently done. And the previous doctor had drug his feet for quite a while on selling the practice because of he was going to retire, and then the stock market dropped, and then he couldn't retire. And so he was in a position where he was taking quite a bit of risk, so much, in fact, that when the stock market had dropped enough, it ruined his chances of retiring when he thought he was going to. Therefore, he didn't sell the practice when he thought he was going to, and it kind of messed some people up. So there's 2 different kind of situations on the spectrum. Someone not taking enough risk, and then someone who's taking way too much for being that close to needing the money.
Yeah. Lot there in that example. Like,
there's a ton. Yeah, it's just fresh on my mind today. We're just barely talking about this.
Investment risk, I think, is something that a lot of people don't realize what it means to take risk in your investment accounts. I think they associate it with loss.
That's the first question. Yeah, like what does it even mean? That's what I would ask you. Explain to everybody what does it even mean, and what's the difference between like volatility in a portfolio going up and down versus risk. Does risk mean it can just disappear? How about we explain that for a little bit?
Well, I think the more you concentrate your investment, you run the risk of loss, complete loss. The more your investment is concentrated, the more you can lose all of it.
Okay.
So if you take all of your money and put it into a dental practice and you become disabled, you could lose all of your money. Like, that's a possibility.
Yeah.
If you put your money inside of 10 dental practices, you might not
lose one of them.
Only if we have some kind of a massive catastrophic event. I can think of several.
Don't mention earthquakes, okay?
I can think of several. Ryan
10
has
practices
a fear of
on a fault line, and what do you know? The earthquake hits, all 10 are gone.
The San Jose
practice chain.
Yeah. So
San Jose Dental. It probably exists somewhere. Sorry
about that. Yeah.
San Andreas Dental.
The San Andreas dental
chain
group.
Yeah, it probably exists.
So if that's the case,
shout out if it exists.
Shout out to you guys if you're out there. If that's a risk, but the more dental practices you would have, the less risk you have, right? But you do have a risk of the value of all your practices declining based on some kind of a macro trend. Maybe people decide that they want to stop going to the dentist and they believe that their toothbrush is good enough forever.
Yeah.
That could happen. Yeah. Unlikely, but then you'd have a macro trend that would affect the global market of dentistry. The same thing would happen in the stock market, right? You have one company you invest in, you have the risk of loss because that one company can go bankrupt. If you spread your money across an entire market, meaning you owned every company in the entire market at the percentage that it existed in the market. So Apple stock gets maybe, almost 2% of the market because it's the biggest company in the United States. And then so on and so on, you get 3,000 plus stocks. That's going to be what we call, in that scenario, is it possible for that to be worth zero? It is. It's just an inconceivable world event, right? That would mean that
you'll have bigger problems to worry about.
Yeah, there won't be bread and food.
Yeah.
Right?
Yeah.
And so it's not likely what'll happen in that scenario is you have the risk of it changing price. Price changes happen every day, and you'll see that movement go up and down. The issue we're talking about here, we're not trying to make this be a market discussion too much today. We're trying to make this be a discussion about when you take risk in your investments, if you're properly diversified and you have a portfolio that's being managed in the right way, you'll have the risk of volatility and you'll have the risk of movement, but you won't have the risk of your money disappearing. And I think that's what people fear. Strangely enough, they fear like if the price of this thing has gone. Like if your house drops from, let's say it's worth $1 million one day, and 2 years later it's worth $800,000. I mean, that's sad. You're bummed out about it. But do you wonder if the house is going to be worth nothing?
No.
Is that a thought you have?
Yeah, never.
No, because there's like some wood there and
Some land.
you have some old carpet and some dirt and a tree. And you've got some tile and bricks, and it feels like a structure that could never be worth zero.
Yeah.
So you sit in it, and when the real estate market declines, you don't go, I got to get out of this thing before it goes to zero.
Before it's worth nothing. Yeah.
And really, the stock market is just as much a pile of bricks and mortar and dirt and trees. I mean, there are many stocks in the stock market that literally only own trees. And you own those pieces of things, and they can't go to zero.
Because the trees are still there.
Because the trees are there and the bricks are there and the things
or the
are there.
potatoes.
Does the market have a swing set?
Yes.
Yeah.
Okay, I just wanted to check.
There's a lot of stocks that only make swing sets.
Yes.
Okay. So I just think it's important for people to know that an investment account risk, if it's done properly, you can measure a future movement that you can expect. You can build your portfolio to where it has a precise down movement that you can kind of forecast and say,
or at least know what the worst case could be.
This could be the worst case for me in a year, or this would be the worst 2 year, or this would be the worst 3 year period. And that helps you kind of stay consistent as you go throughout your investing lifetime.
Yeah. And that was kind of my point I mean, most people have heard the stories or somebody back in 07, 08 that was on the brink of retirement and then couldn't,
Yeah.
And that's just a result of being within that, short window of needing the money where they or someone they were working with wasn't considering that as an option. Like the way you're invested historically has lost 50% in a really bad year, or historically has lost 30% in a really bad year. If that happened, could you still retire in 2008 like you're planning on it? And if the answer is no, then that you don't have the right risk allocation in your portfolio. So the whole point, like my conversations today or the way we talk with our clients, is that at some point before you think, if you're measuring, again, on the bottom row of that periodic table, we measure something called total term, which is a measure of how close to someone being financially independent, work optional they are. And if you're tracking your net worth and you're getting close, work is optional in maybe the next 5 years or so, that's a really good time to start asking yourself questions about how much volatility could I bear and still walk away from work like I'm planning on. Can I lose 20? Can I lose 40? If you can't, and your portfolio is built in a way that historically it could be exposed to that kind of loss, then that's when you need to make changes.
Yeah. And the biggest risks come when you've got an investor approaching retirement and they've got a tilt towards equity or stocks that's so high that they are going to get killed at some point in the next 5 to 7 years. Lose confidence in the entire financial sector because we're taking too much risk.
Not retire on time, not recover.
They'll bail, they'll go to cash, they'll sit on the sidelines forever. Then you end up having like this big kind of confusion and misunderstanding about investing, and people just blaming the economy, blaming the market for not being able to retire on time. And the reality is the markets really have been fairly consistent in the amount of volatility that they give you. And you can kind of measure, to some degree, you can kind of plan for an expected decline in a market. And you need to just be prepared for that. And a good advisor can help dial that in better. So let's talk about the second risk in that top row of the table. The second risk that I don't think people would often think of.
I was just going to say that. It's not viewed as a risk.
Yeah, is what we call profitability rate, or the risk around your profitability. The risk around your income as it relates to your collections. And I guess why do you think this matters to understand this at all?
Yeah, well, I mean, you were kind of alluding to this. As we're talking about protecting investments and the risk you take in different investments, your practice might be one of your biggest investments that you'll ever have, given the time and money that's gone in even to getting to that point of being a dentist who can practice, So profitability is like a measure of, it's like the return on your practice. It's a measure of of how successful the practice is and how efficient it's working. And so measuring profitability, like you said, doesn't really get viewed as a risk. But if your income is, 5% lower than it should be for decades, then there's been a risk there that has been taken that didn't pay off somewhere. And it's to your detriment. It's to the detriment of your net worth and your income.
You could have
your
been
cash
taking
flow.
a risk in what? What kind of categories are you talking about?
Well, I mean, what do you mean? Instead of...
You're saying if my profitability was normalized, and I was making, let's say an average dentist is going to try to run a 20% profit margin on their business. That'd be really healthy.
Right.
After they get paid 30% for their own production. And let's say someone's at 25% profit and someone's at 10 or 15. You've got people that are at very different spectrums of profitability. Where are the different, I guess you're saying they're investing this money hoping that they're getting a return out of it, but it might not have paid off.
Might not have.
Do you think people actually think about it that way?
Not really. No.
They're not thinking about it that way is my assumption.
They're not.
It's okay to have a lower profitability if you're consciously pursuing something that is going to result in your enterprise value going up.
Well, that's what I was going to say. So one thing I would say is most of the time, just even in the simple calculation to measure that, all it is just the income you're deriving from the practice divided by your collections. But in most cases, even people who have a general idea about their income, it's taken from like a personal tax return that's not a true income number. There's been deductions and write-offs that have discounted what the true gross income from the business really was in the first place.
Yeah, so if you're calculating this, you take your true collections and you say, this is what I collected in a year. And then whatever I paid myself, right? Usually that'll show up in what's called officer's compensation or a salary and a wage. You'll see that either
W-2,
on your tax return or on your P&L. You add that number to your net income, and that's what gives you your idea of your total income number, right? But I would say it's healthy. A lot of people don't think about it this way, and I would rather have people think about it this way. There's wages that you get paid for work, and those should be fair market. So if in your area, doctors get paid 30%, or if in your area as an orthodontist, people get paid $2,000 a day, or they get paid $1,500 a day or $1,200 a day, whatever the daily rate is or whatever the percentage is, that's your wages for your work. That's not profits. Don't think about it that way. Don't call it profitability. That's just what you're getting paid to do the work. So if above and beyond that, you should have a profitability number. And if that profitability number is 0, meaning you're really only making 30 to 35% of production, or you're making $1,500 a day or whatever your number is, and that's all you're making and there's nothing left over, there's some major problems with the enterprise. It's either you've got too much overhead for the size you are and you need to grow your way out of it and get bigger, or you're putting money in places that aren't paying off. Your costs are too high, your lease is too high, your supply costs are too high. Then you need to separate out wages for the work that you're doing from the profits. And then we can have an intelligent discussion about what is profitability.
Yeah, what it even is.
Right? Because so many people throw like, I run a 60% overhead, or I run a 40% profit, or all these numbers kind of get thrown around, and it's sometimes confusing and it sends the wrong message.
Yeah.
So just make sure as you hear things around you that you're separating out this wages for work, the right amount you should be getting paid, what you'd have to pay an associate to come in and do the work.
Yeah.
That was at your skill level, and then the profits that are left over.
Yeah. So you mentioned adding up income sources from your W-2 net income. There's a few other categories that we'll add back in for gross income sometimes. Large depreciation or amortization write-offs that were expenses that reduced the income on the tax return but weren't real expenses. So that was cash that you actually received.
Yeah.
But
I don't know that people actually understand what that means either. I mean, so when you have depreciation or amortization, that means it's making it look like my income is lower.
Yep.
So it might show up just right next to my marketing or supply costs as an expense.
It's usually line 14, I think.
But it's not really an expense.
Yeah,
I didn't really write a check.
Yeah, no.
Right?
You didn't pay anyone.
I could have borrowed money to buy a cone beam, and I got $100,000 of depreciation.
Yeah.
And it makes my income go down on my tax return. But it really
every
was
year
money
you might
I
write
had.
every year you might write off 20 grand of that 100 or whatever. But
So-
you didn't really write a check for that 20.
So you're just saying, before you say what your income is, just add those things back in.
All the sources. Yeah, if you have large pension contributions from the practice, which is your business, your income, maybe a lot of personal expenses your accountant is having you flow through. It's just let's find a true number for what the income really is. But B, to your point, what are the sacrifices someone could make for lower profitability, and how do you gauge and judge those things? I think we chat about that for a minute.
Yeah, I think that's really healthy because I think there are many times where it's okay to say, look, I'm just going to get paid wages for the work I'm doing, but I'm going to reinvest my profits in growing my company.
Right.
A single practice dentist can still reinvest his or her profits into growing their single location. And the reason they would do that is if they make those profits and they just earn them, they pay 30 or 40% in taxes on them, sometimes as much as 50%, and you're only left with half the money anyway.
Yeah.
If you reinvest it before the year's over and incur expenses like marketing expenses to help you increase your new patient flow, or you're able to buy equipment that increases your productivity, or you're able to enhance your location by moving to a space that gives you more capacity to see more patients, or maybe invest in an associate in your location to help increase the production that you guys can do.
Yep.
Invest in another hygienist, invest in an office manager, invest in a marketing a marketing agency or a consulting company to help you figure out the right way to expand. Even in one location, you can still defer some of that profitability and grow. But there's also, this is the way that larger businesses get built, is by opening a second location and adding associates and adding partners to that mix of businesses.
Yep.
And the only way you do that is by saying, I'm going to have to lower my profitability for a
Lower
while.
profit and invest the profit. So that's why there's different ranges of profit. That's what you were saying. Don't be so general. I run 40% profit or 45% profit.
Yeah.
There's different ranges depending on how many locations and how many partners or associates, how many clinical days. Maybe you work 5 days, but only 2 are clinical.
Yeah.
And so they'll range completely. But the whole point is, why would we want to measure this profitability? Like, what's important about visiting this subject once a year, whether it's the dentist or someone they hire, to just visit it, and when tax returns are done, add up all the income sources, divide it by collections, and then just kind of analyze where profits and how it's trending and how that compares to the decisions they're making in the business. Why do you want to know that?
Well, the reason we take time to look at it is, number one, if you don't take time to calculate it at that moment, you don't really know what someone's income really is.
At the most basic level, yeah.
You don't even know what you make.
Yeah. So then answering the question, where does my money go every year into different categories? There's no way to answer that if you don't even know what's coming in the first place.
Yeah, your savings and your spending and your taxes and your debt, they all get spread to somewhere. And the only way that you figure out, whether you're making progress or not is by starting with an income number that you calculate the same every year, using the same technique and the same line items and the same numbers. So it gives you a baseline of saying, this is what I earned. That's the first thing. I think the second thing is, depending on what you're trying to accomplish, your profitability tells you if you're being successful at that. If you're trying to expand your practice and consequently your profitability is lower, then your collections should be going up eventually.
Yeah.
If your collections are not going up and your profitability is down, then something that you've chosen to do is not working. There are great...
Could be the associate, could be the second satellite location, could be the marketing program.
Yeah, it could be the staffing that you tried to, it could be the person that you hired is just not really executing their job effectively. There's a lot. If your profits are lower, your collections better be growing. And that happens a lot where people say, okay, my collections are growing, my profitability's maybe down a little bit.
And you guys are talking about profitability percentage in this case.
Yeah, that's good clarification. The percentage of profits would go down is what we're referring to. But in a lot of cases, that for most people that are in dentistry, that'll affect your dollars for a while as well.
Equally. Yep.
Until your collections grow a little bit, you might see that dollars and percentage goes down for a while. Just because your percentage is getting a little bit lower doesn't necessarily mean it's a bad thing. I mean, if you had 3 locations and each of those locations is doing 15% profit, that's better than, that's not necessarily a bad thing. One person at one location might be able to get that one location up to a 25% profit margin where they're really, really running a really efficient location, maybe even higher. Or someone who's got 3 locations because they're providing maybe better benefits to their staff.
Except more staff, more people to pay, more marketing.
They have more marketing. The dentists are doing more production. Maybe they just have a slightly lower profit percentage, but they're happy with that because at the end of the day, it's bringing in more
it's a
total
bigger
dollars.
Piece of the revenue.
So in a simple thing, what does profitability tell you about risk? If your profitability is too low for too long, it's basically telling you that something you're doing is not working. It's a great indicator of telling you what's not working. And I think that it's okay to have to defer that for a while, but you really have to take that profitability seriously because every year that you work and you don't claim both the wages for work that you deserve or the profits that you deserve for taking the business ownership risk.
Your investment isn't performing.
Your investment is not performing, and you probably shouldn't have started a dental practice anyway.
Yeah.
You should let someone else run that practice and you just work for them because at least you'd be able to make the same wages and not have to deal with any of the headache.
Yeah.
And so if it's not working, then that's a sign that you need to fix something. Most of us who will have ever been involved in starting a business, including me and Ryan, will look at this and go, we're not always going to be able to have profitability be perfectly where we want it. It's going to ebb and flow. There's going to be periods of time where it's going to decline. It's going to have periods of time where you're going to have to invest more in order to see higher profitability down the road, or a business that's able to service more people, a practice that's able to do better. But I just think that we want to see that profitability is being tracked and measured and it's not being neglected, and people aren't making excuses for why it's okay and everything's fine.
Yeah, why it's down.
So you can't go 10 years with an
Subpar,
underperforming profitability measure unless the practice is growing. If the practice is becoming worth more, man, maybe like a lot of technology companies do this. A lot of internet startups don't have any profits for 10 or 12 years.
Amazon.
But the top line business, the collections, right, are growing like crazy.
Yeah.
So you're doing 40 or 50 million in collections because you've got to, 40 locations.
Yep.
Your profits are still not quite there because every time you barely have any profits, you're opening another location.
Yeah,
and
hiring another person. Yep.
That's a really aggressive strategy. But some dentists who aren't even trying to do that are running no profits. And that's where it's kind of...
So this is where organization of a balance sheet and just knowing where everything's going will pay off. Because if you are tracking low profitability, but your strategy is growth, you should be able to see it being recaptured in your net worth, in your balance sheet, because your company's it's growing, it's worth more money.
Yeah.
Right? Or collections are growing. You should be able to see that trend
kind
of correspond to the low profitability.
Yep.
Okay.
Yeah, I think that's great.
Well, let's go to the third one, which is the most easily associated subject when you talk about risk management, which is insurance.
Yeah.
Right? And with our clients, we visit this subject once every year. And we're talking about 3 main lines of insurance. So we're talking about life insurance coverage, disability coverage, and liability coverage.
Yeah.
So what I was going to ask you first is, let's start with life insurance. What's one of the biggest mistakes you see people make with determining how much or what type of life insurance they should carry?
Well, it's kind of like they do it like sometimes like they do with a mortgage. They'll just go to the provider of the person that's selling them something. They'll go to the mortgage broker and be like, how much of a house can I afford? And then the mortgage broker says, you can afford this much. That happens to be 42% of your gross income. Yeah. But that's what you can afford. So they say, that's my budget.
Yeah.
And then I go get a house that's in that budget range. A lot of times people make life insurance decisions based on one of those 2 things. They either a budget or how much can they qualify for?
Yeah.
So it's like, what do I qualify for? How much
I think
can
it's probably
get?
more often in the budget.
But it's usually budget.
Yeah, it's
right?
like what's my mental threshold for how much I think is worth paying for life insurance? $100 a month, great. What does that get me?
Yeah, 500. That seems like a lot. What do I get for that?
Yeah.
And really, like the American Dental Association's life insurance plan is, like in my opinion, there's a lot of different places to get life insurance, and some of those places have companies who have been around longer, might have stronger financial strength reputations, but almost every insurance company, life insurance company in the United States, is guaranteeing to pay a death benefit. And they are insured by the state in which they operate up to a certain amount.
Yeah.
And so the risk of a life insurance company going under is pretty low. And the American Dental Association has a contract. Right now it's with Great West.
Yep.
And you can get annually renewable term insurance that just goes up every year as long as you age. It doesn't ever get crazy expensive, but it goes up every year. And I mean, if you own it when you're, I don't know how long it goes till you're 70 something.
Yeah, it's like late 60s, early 70s where they won't let you do it anymore.
At that point, it gets like pretty expensive, right? But there's really no reason to have, in my opinion, to have less life insurance coverage than you need, because the cost is pretty inexpensive if you get it from the right sources. Like I'm not saying this is the only place to get your life insurance. I'm just saying if you're on a budget and you're trying to cut cost, but you still want to have enough coverage.
You belong to an association that's discounted it heavily.
Yeah.
So take advantage of it.
And it's, it's just going to fit within your budget. And so I think there's not really an excuse to not have, as a dentist, there's probably not an excuse to have enough coverage, to have the right amount of coverage. And the right amount of coverage is probably, we feel somewhere around 30 times what you spend in a year. So if you just take what you and your family spend in a year to cover all of your expenses, this is super rough. We're not going to go into the exact calculation, but
email me if you want to.
Email Ryan.
Ryan at dentistadvisors.com.
He can help you kind of understand the exact calculation, or you can listen to a couple of our podcasts we've done about insurance. But that's probably enough coverage. It's probably more than enough for most people. But you can get that amount of coverage for not a lot of money. Or you can go and buy any number of very expensive policies that don't get you enough coverage. So one mistake would be, I decided to buy variable life or whole life or indexed life or some other kind of life insurance that was a permanent policy. But since I did that, I can't afford any really. I couldn't afford as much.
I have like a tenth of what I actually need.
Yeah, or I got a little bit of term, but I'm putting so much into this whole life that I'm
It just hurts to buy more.
So I'm not, I thought it was enough.
Yeah.
And I just think there's more of an actual calculation that you should be doing here. And the point of buying life insurance is to take care of your family if you die, and you want to make sure your family's actually taken care of
mathematically
if something happens.
Would you say the people you meet on average, would you categorize people you meet in regards to life insurance as underinsured adequately or overinsured? More
often than not, you're going to be underinsured.
Okay,
right?
I would say the same thing. Yeah.
Then there's a few people that randomly have like way too much. I'm like,
that's
dude, you're
so rare.
You're carrying like
5 million more than you need.
You need like 4, and you're at like 11.
Yeah.
How did you get this much insurance? Did you tell every insurance company?
How's your marriage?
That you actually had this much insurance? Because usually they won't let this happen.
Yeah, you're going to be killed off.
So
man.
Another important thing to just consider, I think, is making sure that you know how to buy it, who to buy it from, who to get advice from around it. We have a couple of episodes. If you listen to episode 57 and you listen to episode 25 on the show, we go into this in a lot of detail. I think that's probably enough for today, but I just think that if you want to find 2 quick places to get like quotes from, you can go to the ADA's website and get quotes from them there, and they're just direct like group rates. It's not the only coverage you should consider, but I'm perfectly fine if someone's on a budget and they're like, dude, things are kind of tight.
Yeah.
I want enough coverage, but I don't want to get it from, XYZ carrier, because
I don't want to pay a premium for my term life insurance. Where can I get it the cheapest? That's a good place to start.
There's a website called Term for Sale, TERM, the letter or the number 4 sale, SALE.com. And that you can like type in your age and get quotes from there. Sometimes the reason I like that Term for Sale site over, there's a lot of like online brokers you can get quotes from. but a lot of the online brokers only quote like certain carriers.
Yeah.
Where this one will quote like
There's like
all the carriers.
Yeah, all of them.
So they take the captive carriers that you can't even buy without like a captive agent. They quote all of the brokered carriers. They just have a lot more.
Yeah.
They try to bring in all the data.
Turnforsale.com. So if you ever want to go
Yeah.
check your price or look at what more coverage might cost you, that's a good place
It's just
to
like a piece of
start.
software.
Yeah.
And it's
yeah.
a company that sells software to independent
They
advisors.
haven't updated the user interface for
It's
quite some
pretty
time.
bad. And by the time,
It's fine,
in a few, this is 2017.
It still looks the same as it did 10 years ago.
It may be broken by the time someone listens to this in the future.
So here's my question is, why is it important to visit your life insurance coverage every year? Why does that matter?
Well, as your net worth keeps growing and you get to be worth more money, the amount of life insurance you need declines. So if I say today you're worth nothing, you're worth zero, and you need 30
Whoa.
times your spending,
Whoa.
okay?
You
Okay.
have no net worth. You
Yeah.
are worth something.
You are worth something, just not financially, okay?
If you die, you are.
Yeah. Yeah, if you die, you're worth something, but not alive.
Yeah.
I've been that way for most of my adult life.
Yeah.
So I'm not
You're like the
judging
guy
you.
from It's a Wonderful Life.
Yeah. So if you have that 30 times your spending that I said,
Yeah.
and that at the point where you're worth zero financially, you get all of that money and that's adequate. But then the next year you're worth 200,000 because you've saved some money and you've grown a practice a little bit. Well, you need $200,000 less in life insurance. And if you don't make those adjustments every year, you're kind of just overpaying for insurance that you don't need.
Yeah, and not like every year you'll cut life insurance
No.
by 50 grand or something. I just had this exact conversation today with someone with a 36 total term who carries a couple million in life insurance and was like, I can cut this now, right? And it's kind of like, yeah, technically on paper you could cut this. Yeah. So yeah, there is a point. That's why it's important to visit every year. Or the reverse could happen. I mean, you build a building or you start spending way more money. Your multiple of spending that you were insured for has, gone up, or the amount of debt that you'd have to pay off if something happened has now gone up. You might need more than you needed last year.
Yeah.
So it's something to think about every year.
Yeah, and I would say that's life insurance in a nutshell. We're not going to talk about product today, but the reason we use these three types of insurances as the major measurements of risk, Ryan said it was life insurance, disability insurance, and liability coverage, is because these are the three that if something were to happen in one of these three areas, it could be like life-changing financially. I mean, we're the reason, like as of today, 2017, we're not listing like health insurance in that category as something that would be catastrophic is most people carry it.
Yeah.
And by law, it has certain requirements
right now,
that require people to have enough like lifetime benefit to where someone wouldn't go bankrupt, even with serious illness or condition. So unlike, let's say, life insurance, it's completely optional to even have.
Yeah.
Health insurance is not now it's not only
Your car insurance, your home insurance.
your car insurance and your vehicle insurance. I mean, it's important to have adequate liability limits on those.
Yeah.
But if the car blew up and went up in smoke,
You can't even drive if you don't have it anyway.
it's $50,000 down the drain.
Yeah.
But if you run into someone and accidentally kill them, you've got millions of dollars in liability that you could be due for a wrongful death claim. And so the liability side of your property is much more dangerous than the actual property damages.
Mm-hmm.
So if your house burns down, but you have a big mortgage on it, your equity went up in smoke. That's why I don't recommend paying off your house in tiny little partial amounts. I usually recommend like either just follow the mortgage or pay
Save
it
it somewhere
off,
else.
pay it off in full.
Yeah.
But like little partials and leaving
Yeah.
yourself with no money. I mean, it scares me.
Okay.
Someone can disagree with me in
An
another
earthquake
day.
might hit.
I just
Or a
recommend
fire,
follow your mortgage until you got enough money to pay the whole thing off. It's a lot safer.
Okay.
It scares me.
That's
less.
episode 101.
Yeah, we're
That's
going to tackle that later.
That's the future.
But liability, so I don't know how much detail. I think it's important to just say liability and disability and life insurance are the ones that are the most crucial.
Yeah.
Now, disability insurance, without diving into the weeds on this, I think it's just important to say it's much more complex than buying life insurance.
Yeah.
And there's a lot of features in disability insurance that don't make it quite as simple as Are you dead or
It's
not?
harder to buy. It's easier to figure out how much you need because it's just cover your spending.
Yes.
But it's way harder to buy because the fine print really matters. Every company will define your disability differently.
Yeah.
You can add a dozen different riders onto the policy that some are pretty crucial to not miss, and then others are fluff and don't matter as much. So it's way harder to buy.
It is a lot harder to buy, and it's something that we've dedicated a lot of time to in the past on, and we'll have more content on in the future.
Yeah. Same concept though with monitoring it every year is that as your net worth grows, you self-insure a little bit more every year. So your need for disability insurance, which is probably one of the more expensive policies you'll pay for, it shrinks as your net worth increases.
Yeah.
Which I was going to say is the inverse, though. That's not the case with liability. And this is one of the mistakes people make with liability insurance coverages, like their malpractice or their personal. A lot of people don't cover or carry personal umbrella policies. But as their net worth increases, a lot of times they don't increase that. You know, you might have a net worth of $3 million and a per occurrence liability policy of like $500,000.
Yeah.
And as that net worth climbs, it's got to keep pace, or you have a net worth that's not covered by insurance if you got sued. So that's the one that's different than disability or life, that the wealthier you get, the more you actually need.
Yeah, it's true.
So,
and I think the one thing I'll just say about disability insurance is, again, like the ADA has their own product, and it's going to be much less expensive than some of the carriers that probably most of you own. And the ADA's policy, you can buy it like annually renewable, where it goes up over time, or you can buy other carriers the same way. The bottom line is it really is the difference between, from our perspective, I would rather see someone have the right amount of coverage at a price they could afford than undercovered
and
with
premium,
a policy that's better.
Yeah.
I don't care if it's like the best disability insurance in the world.
If you spend
$15,000 a month and you're insured for $7,000 a month with the best policy in the world, I'd rather have you be $15,000 a month insured with a policy that was not as good.
Yeah. It's going to require you to be really disabled to collect on that, but that's what you're buying it for.
Yeah. Well, I'm just saying, like, most disability policies, all disability policies will cover you in the situations you are in the worst case scenario.
Right.
You are paraplegic. You cannot use both of your arms.
Yeah.
You can't see.
I'm so depressed.
You can't talk.
Awful.
You can't hear.
You crashed on your bike.
These are things that every policy will pay you for.
Yeah.
Now, where it gets really dicey is these partial disabilities.
You come back to work later, not at full capacity, not at full income earnings.
You're hurt, but you're not out for the count.
Yeah.
You can work in something that's not dentistry, but you can't do dentistry.
Yeah.
Like, I'm just saying, you can get really caught up. Like, if you come over and you tell me, let's say you're a general contractor and you tell me about insulation in my walls. All right. There's 12 inches of space between, your framing joists that you can put batted insulation in. It's like that Pink Panther stuff that you see just rolled in there.
Yeah.
Or you can put a spray and foam in there, or you can put like 40 different types of insulation and the spray and foam plus the batting. Plus you could have it be, non-toxic, or you could have it be toxic and it's cheaper. Or like, if you sit in front of the insulation guy,
and it might cause a disability.
Might cause a disability. If you sit in front of the insulation guy and he explains the 10 different ways that you could insulate your walls, and you let him explain them all to you, you're going to be sitting there going like, no matter what I pick, I think I'm in trouble.
Yeah, I didn't do it.
Because I have too much information.
Disability does feel like that.
And I don't know what to do now.
Yeah.
Because if I don't pay the maximum amount for the most expensive
there's a situation that
will hurt me.
Yeah.
And there are a lot of things like that in life. And all I'm saying is, insurance ain't free. And so we can't afford it as much as we might want. Just like I want my house to be perfect and my car to be perfect, and I want my vacations to be insured, and I want my iPod to be insured, and I want my fridge to be insured. I want all of these things to be fixed. I still run with my iPod.
Okay. It's like huge, strapped to your arm.
So ultimately, I think at some point you just have to say, okay, if this is my budget, then I'm
adequate coverage first.
Adequate coverage first.
Okay.
And there's a lot of carrier options out there. It's not just like the
there
ADA.
And they are getting more competitive than they were even like 5 years ago.
And so here's another thing. People want to pick level term or level disability benefits because it feels safe. It's like, well, if I pay for it now and lock in my cost, it'll never go up on me.
Yeah.
But by doing that, it usually pushes the right amount of coverage outside of your budget.
Yeah.
Sometimes now you're saying, well, I could have afforded $15,000 a month in disability, but
on a what they call graded or an increasing.
If it was increasing every year, just a graded benefit, graded premium.
Yeah.
But since I want to pay for a level premium and lock in my cost, I'm just going to go with 9. Yeah. But it's like
I think I can cut. Hey, if I was hurt or sick and I wasn't working, I think we could cut.
If I was really hurt and I lost my income and increased my medical expenses and had to like be in my home in a bed and have constant 24/7 attention medically, I could cut my expenses.
Yeah. Okay.
No, you cannot.
I'm glad
do
you're bringing
that.
that up because you can't say that. Okay, that's a really good point. So adequate coverage amounts first. Second is do not assume, just like in retirement, do not assume that somehow magically you're just going to be like, I'm going to chop half my spending off.
Yeah.
Because if you're not doing it now, you can't do it. It's not going to happen.
Yeah.
So don't assume that spending will just reduce or be gone or something.
Yeah.
All right, so recap, measure and analyze at least annually 3 areas of your financial picture that are considered risks: your investment accounts, your practice in terms of profitability income, and your insurance policies.
Yeah.
Life, disability, and liability.
That's how you manage your risk effectively. Okay. It's a risk management 101 for a dentist.
And they're always changing. That's why you revisit them at least every year. They're always different, the variables and everything. Okay. Well, thanks for joining us today. We'd like to invite everyone to check out our new YouTube channel. So the Dentist Money Show is now on YouTube. It's very cool. We are also going to be at the Greater New York Dental Meeting this November, just the weekend after Thanksgiving. You can go to GNYDM, is that right?
Yeah.
.com, GreaterNewYorkDentalMeeting.com, and check out the dates. We'll have a booth there. The Dentist Money Show will be doing interviews and broadcasting from there. And if you go to our website, dentistadvisors.com, and go to the top, there's a little link that you can schedule an appointment to talk with us.
That's the appointment bell.
You won't hear that on the web. Maybe we'll build that in. We should build that in. You click
It's a C for schedule.
You click it, schedule something. We'll have a free consultation about your situation and help answer any questions.
Literally, every time someone schedules an appointment, I literally pull out this xylophone and I hit the C.
That's a liberal use of the word literally.
My actual
wand.
Well,
thanks everyone for listening and for joining us, and we will see you next time.
Carry on.